Hey guys, welcome to I think it's the fourth video, but the third lesson in this series. And today we're going to be touching on a super key concept because last time we did talk about, what did we talk about? I think we talked about finance fundamentals and we talked about time value of money, all that stuff. And previously, before that, um, I think I made a video about what investment banking is, all the stuff you need to know about that. And the video before that was just an introduction video. So now we've made it a little further and let's continue. And this is where it starts to kind of hit these um, interview questions that you do tend to see a lot. So here in this chapter, we're going to be talking about accounting and the three statements. I don't want to make this video super duper long, so I may make a separate video on how the three statements connect because there's a little back and forth going there. In this video, I'll talk to you about kind of like what accounting is really, what each statement is for, the different line items on each statement, because I think that will already take us to like a pretty decent timestamp, so I don't want to take up too much of your time here. And in the next video, we could talk about how the income statement, balance sheet, and cash flow statement really connect. Okay, so let's start off, right? Shoot, this is like super misaligned. Is there any way that I can move this? Yeah, that's cool. Okay, so let's start off. Accounting, right? Apologize if my handwriting's not good. It's never been amazing. But basically, imagine you run a small food truck, right? And let's just say at the end of the month, you want to answer three simple questions. Number one, did I make money? Did I make money, right? Number one, did I make money? Number two, what do I own? And what do I owe? That's your second question. So what stuff do you have as assets? That's the what are your assets and what are your liabilities? What things do you owe? Did you take any loans? Do you have any debt that you need to pay off? And number three, how much cash? Let's underline the word cash, liquid cash, is in my pocket right now. I'll start right now, right? Basically, to sum this up, these are the three. These kind of just go with the three financial statements: the income statement, balance sheet, and the cash flow statement. And accounting is just like the neat, agreed upon way to answer those three questions, so that anyone, whether it's a bank, an investor, the tax office, can read your answers and just trust them. And that's kind of the entire point. And if you ever feel lost within the three statements, just think about these three questions. Number one, did I make money? Number two, what do I have? Assets, what do I owe, right? And how much cash is moved. And basically, let's talk about what these statements are for, right? Basically, a company it does so many different things, right? Let's split this up. A company does so many different things. It can sell products, right? It could sell products. It could, buy machines, so buy inventory to help them with their business. They can borrow money from other businesses or from a bank. Let me delete that. They can borrow money, right? Or they can collect stuff from their customers, collect money from their customers. And basically what accounting does is it takes all this stuff up and just pieces it together, packages it super cleanly for us so we could just look at all these details specifically, and each one answers a different question, right? So remember these three questions, they all correlate with a different statement. Number one, let's split this up into three columns, right? So these are your three statements that you need to know. They're 100% going to be tested. Accounting is always tested in IB interviews. And wherever you go, accounting is just a really good thing to know. So let's just say, here's your income statement, right? We'll just write income. Here is your balance sheet. This is a balance sheet. And here you have your cash flow statement, right? So in your income statement, it's over a period of time, right? Because if you look at that, if we come over to our balance sheet, the balance sheet is basically a snapshot. That's what you're going to hear a lot, a snapshot on one day, right? This is just a snapshot on one single day. And then here again, on the cash flow, you're looking over a period of time. You're looking at the cash flow over a period of time for a business. So what I mean by a period of time, this could be from, let's just say, January 1st to December 31st, right? A year, a period is, let's just say a period is a year. Here, specifically, they could just take the balance sheet for like July 20, today's the 22nd, or yeah, today's the 22nd. So they could just do the 22nd here, right? So that's what it is here. And like here again in the cash flow, you can be from Jan 1st to December 31st, right? Once again, apologize if it's a little messy, just trying to get my thoughts out on some notes. But here it is. So let's see, you may be wondering, what does the income statement talk about? What does the balance sheet talk about? What does the cash flow statement talk about? Let's talk about this. So your income statement right here is going to be answering the question that did the company make a profit, right? Did the company make a profit? And by this, you basically start your sales. We'll talk about how that process works, but you start your sales, you subtract every single cost to you, right? The amount of money you made, you subtract every single cost that you need to pay off, and then you end up at your net income. So at the end of your income statement, you're going to end off with the net income, right? You're going to end off with net income. With your balance sheet, you're going to be answering the question, what does it own? What does the company own and owe right now? So because if you look at right now, right, because it's going to be a snapshot. It's going to be a specific day. So what does it own and what does it owe right now? And this is where we come to the golden formula of accounting. You're going to need to know this. This is hammered into your brain. It's super important. It's going to be your assets is equal to your liabilities plus equity. And you may be wondering like why this is and like how this works and how it balances out. We'll talk about it when we're breaking down the balance sheet. So to the cash flow statement, right? You're answering for this one, how do I say this? We could just say how much real cash, right? How much real cash, because it's a cash flow, cash comes in, there's an inflow and there's an outflow. How much cash moved in and out? You're basically tracking that. And this is kind of like this is super cool. And I'll just give you a little like a preview on how these statements connect. Your net income right here is going to be added to your retained earnings on your balance sheet, and your net income is also going to be at the top of your cash flow statement. You start off with your net income, right? You start off with your net income at this top of the cash flow statement, which is super cool because they all interlink in one way. So let's delete this for now, right? So if you want to go back, please go ahead. Let's delete this for now. Let me delete this, right? Let's delete this for now, and let's kind of go with like a super simple example so we know we're on track a little bit. So if you watched Mr. Ackman's video on I guess the fundamentals of finance, he goes into the three statements as well, and he uses a lemonade stand as his example, Bill Ackman. So let's just say we can use the same example. I'll also try explaining it. So picture you have a lemonade stand, right? You have your lemonade stand, you have a little lemonade stand, right? And this summer, let's just draw this up. Lemonade stand. This is your lemonade stand. You have your picture here, whatever, right? Let's go back to black and let's divide this out, right? Your lemonade stand. And this summer, let's just say you sold $300 worth of that lemonade. You made some decent money. And you spent, on the other hand, because you're spending something, it comes out of the 300. You spend 120 on lemons and cups, because that's basically stuff that is costing you part of that money that you made. So basically in this, you profited $180. The balance sheet, right? Your balance sheet says today you own a $40 pitcher and $60 in cash. and you owe your sister $20 for sugar, right? So it's basically saying what you own. You own your $40 pitcher. So this right here is basically an income statement, right? It's very simplified, very simplified. Taking your revenue minus your expenses, you get your profit. Simple, super simple, right? Your income statement. Here, you basically have your balance sheet. You have your balance sheet, right? So this is saying that your assets, you have $40 in assets, which is your pitcher, and you have 60 in cash, right? This is your pitcher, and this is your cash, right? And you owe your sister $20. You owe your sister $20 because you borrowed her sugar, right? So that's $20 off the thing. So that's one of your liabilities. So let's divide this and let's come down to the cash flow statement now, right? Cash flow statement. I'm making it super simple so we can understand before going into a little like in-depth one on how they actually look. But your cash flow statement, right? You collected, let's just say $250 in cash because 50 of your sales were on credit and the money has not arrived. So right, say someone says, hey, I'll pay you back another day, and they take a credit from you, and $50 was worth in that credit. So let's just say $50 in credit. Right, so basically that's how it is. It's super simple, and this is kind of a very simplified version of this stuff. And I think now we can get into how they actually look. I just wanted to kind of get this idea through because it is important to understand. So basically in your accounting class or whatever, there's going to be two different things. There's going to be basically cash-based accounting, and there's going to be accrual accounting. For accrual, you're basically companies record all their profit on accrual basis. That basically means that they book revenue when they earn it. So like not when the cash lands, they book a cost when like they use it up, not when they pay. So this is kind of why these three statements exist. So in all your investment banking interviews or anything, you're going to be focusing on accrual accounting. Cash accounting, you may go over it in your class, obviously, like for an accounting class. It's not an accounting class. This is just telling you what you need to know on the accounting standpoint for investment banking. So, like I said, accrual accounting, remember that. That's how we basically do it. And what can we talk about now? Let me think. So let's talk about a little bit of profit effect and cash effect. I think that's also a good concept to touch on before we dive into the income statement line by line, right? So let's just make a little table. Here. Just divide it up into, we can do maybe, we can do like 6 lines maybe. Yeah, we can do 6 lines. So let's just say here is your event, right? This is your event. This is your profit effect. Let's just say profit effect, right? And then this is your cash effect, right? This profit effect is basically accrual. So let's just split this up like this, Okay, so you basically say your event is you sell $100 in credit. So, and the person says, I'll pay you back next month, right? You sell $100 in credit. Right now in accrual accounting, how it works is that you're going to record that as 100 in revenue right now, $100 right now. But cash, because it's not actually paid out to you yet, it's going to be $0 right now, and it's going to be 100 later, right? It's going to be 100 later. That's how it is. Profit, this is basically accrual, and this is cash. So I'm just trying to kind of differentiate, because you may be confused if you're taking an accounting class that, hey, my professor taught me something different for cash, but this is basically how it is for accrual. You say you buy a $1,000 machine, right? You buy a $1,000 machine that lasts 10 years, that's lasting 10 years, right? So this is basically going to be if you divide 1,000 by 10, you're going to get $100. So you basically, this is an expense because you're paying this off over 10 years, right? So you basically subtract 100 from your expense right now, expense per year, right? But basically in the cash, you're going to be subtracting $1,000 all at once because it's taking off that $1,000 from the cash. So let's say here you got to pay this month's wages, right, to your employees or anything. So you pay this month's wages. this is basically going to be whatever that is as an expense. So you subtract that expense in your profit, and then you're also going to subtract that for cash. And then lastly, another example we can do is let's just say a customer prepays for a yearly plan. They prepay for a yearly plan. So a customer's prepaying your company for a yearly plan. And basically for the accrual, since it's earned over the year, it's going to be $0 right now. But for cash, you're going to be getting that amount right now. So it's going to be plus that cash amount. And in my opinion, accrual is just a fancy word for just a fair rule. In this, what I mean by a fair rule is just basically count things when they really happen, not when like the money just happens to change hands, as we can see with this table right here. So that's basically it for accrual and cash. We're gonna just make sure we focus on accrual because that's what we're going to be looking at for these questions.